Firstly, before we go into the charts about the banana zone, let's talk a little bit about bonds. So if you think of an X as a collective hive mind of incredible people freaking out about the dumbest shit over the worst analysis on the world, you're kind of close to how bad it is. And so everybody becomes a macro expert. Everybody becomes an whatever expert. And there's a lot of good experts there as well. There's like so much bullshit about stuff. So let's just talk about bonds in the simplest way possible. Bond yields are going up. Normally that's not a good thing. Generally speaking, Trump and Bessent have said, we want bond yields lower. We want oil lower. We want the dollar lower. Those two things they've had, but bond yields haven't. And then there's a bunch of 1970s gold bugs saying, it's inflation, it's coming back. It's like inflation's falling all the fucking time. In Real Vision Plus, or soon to be Real Vision Alpha, we're renaming tiers and doing some really cool shit with Real Vision. I'll come on to that in a bit. But we're proving to you inflation is not the story. The tariffs were not the story. The story is and has been liquidity. And with bonds, there's a lack of liquidity in the bond market. So we have a liquidity that's driving scarce assets, stocks, but bonds which are not a scarce asset, because guess what? They issue a fuck ton of bonds, squared, and they keep issuing more and more bonds. So what happens is bond markets start rejecting the issuance. We're in the year of the everything code, which is my big thesis, that they need to roll the debt, and therefore they need to get rates down. But as they roll the debt, rates get pushed up. Okay, great. The world's going to end according to X. It's all the worst thing. The answer to higher bond yields is to inject liquidity in the bond market. By July, they will be using the SLR to allow primary dealers to hold more bonds. That is code for, hey, listen, you guys in the banks, stick bonds on your balance sheet, give some leverage out into the world, and hey presto, new bars of bonds. Banks make money because they can lend it out. They were not allowed to do that post-2008. We've got the Basel IV agreement, same kind of thing, rolling out. Hey, banks, take our bonds. We'll make it sort of like it's cool to do so, and you should do it because it's good for you guys. It's the US government selling bonds. The US government, they're in the Middle East right now. Well, they were in the Middle East. They're not selling weapons. They're not selling AI. They're not selling data centers. They are selling bonds. The US is in the business of selling bonds. And so they have to go to the Middle East that has trillions of dollars to buy them, right? So Scott Bessent is a bond salesman. Donald Trump is a bond salesman. They're all bond salesmen. So anyway, so if bond yields get too high, Scott Bessent has already said, as the Fed have said, we will step in. We're getting to the point where Japanese bond yields are too high, US bond yields are too high, and the governments are going to have to think, what do we do about this? And they will find some mechanism to stuff it into the banking system or on the balance sheet of the central banks, sort out the bond issue. That is the benefit of being these gigantic countries and not a small emerging market. You can act like an emerging market and pretend you're not. And you can force your huge savings pools into these vehicles. So bonds, I don't think, are a problem because the reaction function from central banks is always, and in every case, to print more money. They've removed the left tail risk from markets. Also, really, bond yields, 10-year yields, have been a pretty sideways range. In fact, let me show you a chart of that. I've got plenty more charts to show you, and I'm running so late, but the questions will only be on Real Vision, and you'll have tons of questions. This is not going to run for an hour. This is going to run for an hour and a half, an hour and 45 minutes, because I haven't seen you guys in 2 months now. Lots to catch up. I'm feeling on a roll. I've got 2 bottles of champagne open, and worst comes to the worst, I could eat Chick-fil-A and not have dinner. At the same point, so many times over the last few years. So there's actually nothing really going on. Bonds, everyone freaks out about when they get to the top of the range, and then they don't. Now, maybe these break higher. If they break higher, answer is print money, stop that happening immediately. Because if not, you nuke the housing market, you nuke Main Street, and all of the things that you don't want to happen. Beg the Saudis, beg the Abu Dhabi, beg Qatar, buy our bonds, get the Chinese to do the same by agreeing a deal, get the Japanese to do the same, make sure the Europeans buy our bonds, and if not, stick in our own balance sheet, because that's what we get to do because we're the US. So if I share you the charts, or I didn't share it earlier, there's the chart bonds. You can do this stuff. Maybe it's just California. Maybe California, because they make better food than everybody else as well. The rest of you make pig swill. The Californians make actually kind of fresh, nice, healthy food and good wine. But, well, pig swirl, that's probably too strong a word, but you kind of know what I mean, right? Domino's Pizza. Okay, so I'm reading down my list. What am I supposed to be doing now? Okay, let's go to the presentation. The Alpha Zone. Dun, 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 dun. And it's kind of out of order, so it's all going to be really scrappy. And you'll be saying, well, he's a bit drunk, doesn't know what he's doing. I'm not drunk yet. I'm only in my second glass of wine, but I shall be probably drunk later. Listen, the dollar is the largest, most important macro variable on Earth. Nothing comes close. The dollar is 87% of world trade. It's how the US adds and withdraws liquidity to the global system. It's how all commodities trade. It is the big daddy. And what we had is the dollar had been in a very sideways range for the whole of 23, 24, 25. Then it started weakening. It got the most oversold. It got 3 standard deviations oversold. And it's somewhat bounced since. Now, why do we care about that? Because every time it does this, the 12-month gain after a drop of that magnitude is huge. We had it in 2015. The NASDAQ gained 18%, 35% in 2022. And back in 2020, 61%. Things like a weak dollar. The global economy loves a weak dollar. China wants a weaker dollar. Everybody wants a weaker dollar. Scott Bessent wants a weaker dollar. Donald Trump wants a weaker dollar. A weaker dollar is the key to making the world go round. And when it happens, things like Bitcoin go apeshit. So the 12-month gain after a large drop in the dollar, 119%, 175%, 592%. These are big deals because the weaker dollar is a change in the denominator of most assets. The S&P 500 also after the DXY tends to be a very positive thing. So the dollar weakening, you want to go on X and here's some guy saying it's the end of the world because that narrative makes you scared. And if it makes you scared, then you've got attention. The world trades off attention. And maybe when I come and say there's nothing to be scared about, attention goes away because it de-escalates people. And then you go back on X again and somebody goes, the world's going to end. And you're like, oh my God, what's going to happen? Raoul, save me. I'm like, there's nothing going on, guys. Nothing has changed. I've been telling you the same shit since the low in 2022. 2017, the world freaked out. Oh my God, we've got this nutcase as a president. He's going to nuke everything. He's going to come with tariffs. He came in and said the dollar's too strong. Genius. Why? Because the dollar makes the world. And what happens is the dollar fell over the first year strongly. What happened this time? We said this before the dollar peaked. We said it's going to repeat the same cycle. And it did exactly as we said. And not only that, it's falling faster than last time around. And you see these wiggles. So this up move we had very similar up moves in the dollar as corrective moves back in 2017. And then it keeps moving lower. That moving lower is what is increasing global M2 because it's in dollars. It's also increasing or lowering financial conditions or increasing on our charts, which means financial conditions are getting easier for people because of the dollar. Foreign nations can roll their debts. Corporations can roll their debts. That means everybody has more dollars to spend. More excess spending equals faster economic recovery, higher asset prices. So the dollar is in this beautiful cycle. The dollar should hit new lows again. And this little correction pattern is actually important because it plays into the M2 chart and the global liquidity chart, which in the end is what is the key driver of assets, which again, most people don't understand. They get caught out in some bullshit on Twitter. I've been trying to show you this stuff forever. Global M2. Global M2 is the real-time pricing approximation of total global liquidity. Total global liquidity is central banks included. This isn't, but we know what they're using the banking sector. Global M2 is rising faster than 2017. 2017, those of you who were in the market then, it was a hell of a year for risk assets. I mean, crypto from the low Bitcoin from the low did a 23x that year. Now, Bitcoin won't, but something will. One of the large tokens will do something approximating that. So liquidity gushing, dollar falling. I remember putting this bloody chart together myself with Julian saying we were shuffling them around forever and we're like, oh my God, this is so good. It's the chart of M2 versus Bitcoin. This has been so tightly correlated, it's embarrassing. I keep saying maybe it was this easy all along. I've known it will be. I also know it will decouple later in the cycle and it'll decouple to the upside with Bitcoin outperforming global M2. That's how it works when the crowd come in. The herd get FOMO, they get greed. It actually starts outperforming. Then when the market flips, it eventually starts to underperform as fear kicks in. But at this point, it's really driven by liquidity. It gave us a 3 months heads up to exactly the correction. And you don't want to believe it. And then it will break down once you all do believe it, and it'll start outperforming, I think. But just generally, as a rule of thumb, it will work because it explains the asset moves. And I'll come on to that in a sec. So please just pay attention and listen, do me a favor. Julian and I work really hard to share as much information as possible. If you see people using these charts, my charts, just call them out and say, hey, tag Raoul and Julian. It just makes me feel good because we do a lot of work. A lot of it comes from GMI, which is a very expensive research publication. I've been writing for 20 years. And then it goes to Real Vision. In Real Vision Pro, people pay a lot of money for that service. And eventually, and also the macro investing tool, and eventually down the line, we put it out for free to help people. And to do this stuff that we do for free, like this chart, I appreciate it if you would just say it was our work, but really, I'd appreciate just join Real Vision. It's really there to help you. There is so much for you that if you don't join it, just the free side to start with, if you don't come and ask me questions there, I can't really help you. I'm doing the best that I can, but it's not me alone, right? It's not all about me. It's about Julian, it's about Andreas, it's about Jamie Coots, it's about all the guests we bring on. It's about the community, having the conversation, sharing their trade ideas. I can't do it alone for you watching on X with your short attention span. Oh, Raoul said this, he's amazing. Oh, he's an idiot now because it went down 3 days. You've got to do this properly. And Real Vision was set up, I built it in 2014 for all of this.